Okay, let's shift gears a little bit and talk more specifics. I'm going to throw this up there fairly quickly. This is a snapshot of what is currently in the Gecko folio. Again, the income fund. I'm not going to go line by line through these names. In general, I would tell you that we still own a lot of MLPs, midstream MLPs, that is, pipeline companies that essentially transport oil and natural gas all over the country. Great businesses. They have moats. Back when we launched Gecko, when I launched it in early 2009, like many other things at that time, a lot of these MLPs with attractive yields, very significant growth potential in those years and yields, and in general, just great businesses were on sale like other things were. One of the MLPs that we bought back then has since been acquired, but we've still held on to the other two. So to the geniuses in the room who invested early in Gecko, the effective yield they are earning on that the cost basis of those MLPs, most of which have doubled by now. Sometimes it's 15, 16% a year. A lot to like about those in Gecko in general. At the time of the annual meeting, I think I probably had 5 or 6% of Gecko in cash, but that wasn't necessarily indicative of a directional call or anything as much as it was just making some small tweaks to some things. But here, anyways, is what is in Gecko, at least what was in Gecko in mid-May. Gecko has very low turnover. There's a couple extra boxes to check, if you will, on the analysis that's done in companies that go into Gecko. And for instance, I don't normally demand as much of a discount on the shares than I would compared to Tarpon. But a lot more of the analytical work, anyways, is focused on the sustainability and growth of that dividend because it is an income fund. Let's move on to Tarpon. Biggest position in Tarpon for a while, I guess 6 months or so, has been in Markel. I'll talk a little bit more about Markel in a few more slides. Also own shares in AIG, Bank of America. Own some shares in Sears Hometown Outlet stores. And I could read the rest of them just as easily as you can see them. Still fairly bullish on kind of natural gas in general. You'll see both Chesapeake and Ultra Petroleum in there. Some familiar names from last year had some turnover. When I sell things out of Tarpon, it's typically for probably 3 or 4 reasons. The most common, though, are number one, the opportunity cost of holding something has just gotten too high, i.e., there is an even better company that may be more undervalued or with a more near-term catalyst than something we currently own. Or the situation I hope for is that the company that we've bought meets what I would estimate its target price is, or target price is a bit of a misnomer. The range around which it seems to be reasonably valued. I don't ever want to own anything that's overvalued in here, so I try to be pretty unemotional about that. The most significant buying in Tarpon prior to the annual meeting was in that last company, JCPenney. And at the time, it had about 15% of Tarpon was just sitting in cash. Again, that's more reflective of the acquisitions we saw at the end of last year. Clearwire, Dell, McMoran, both created some cash. It's also reflective of just as the market continues to rise, it gets harder to find high-quality, undervalued companies. It's not, and I want to emphasize, it's not a directional call on the market. I'm not sitting around trying to figure out when we should be in cash because it sure feels like the market's about to collapse. Don't play that game. But it is what it is, and that's really the snapshot in mid-May, essentially, in Tarpon. I want to talk about 3 companies from that list a little bit more in detail. The question I asked at the annual meeting was, does anybody recognize this gentleman? And nobody really did. Not that I expect anybody to. And then I try to frame it a little bit more. Then, oh yeah, that looks like that JCPenney guy. And that is, in fact, James Cash Penney. JCP is a name familiar to just about everybody. Sort of the quintessential historical or American retailer. Founded back in 1902, a small town in Wyoming. They listed on the New York Stock Exchange, I think it was 1927, and has more recently fallen on some pretty hard times, which, when you peel back the layers of the onion, are really, both a great opportunity and kind of self-inflicted wounds, if you will. JCP had been on the radar screen, I guess, for quite some time. There's some other very much better known value investors who have, one in particular named Bill Ackman, who'd been sort of making an activist case for JCPenney for well over a year now. It's always good to see what other smart value investors are doing. This, though, to summarize and sort of fast forward a little bit, is the tale of woe of JCPenney over the last few years, in any case. You can see sales just really sort of fell off a cliff. Last year, again, kind of self-inflicted, I'll talk more about in a second, and really had some difficulties. And by the way, when you're looking at that list of companies that represents what's in Tarpon now, or even at JCPenney to some extent, it's all right to be a little bit nauseous. I mean, that's just sort of how it works. The big point I'd highlight here is that JCPenney, the sales fell by over $4 billion on a year-over-year basis, and it quickly got interesting, at least from my perspective, right after that. So a lot of activity around JCPenney, at least in the front office. A lot of you may have heard just in the headlines, JCPenney, essentially due to the urging of the activist investor Bill Ackman, went out and sort of poached the genius Ron Johnson, who had previously led Apple's retail store outlet effort. So he had a long background at Target for that, but really considered by many to be a retail genius. Clearly, a little bit more of that vibe would be good for JCP. At least that was the thinking. And to sort of skip a lot of angst, Ron Johnson came in. Things did not work out. He, I think, in retrospect, even he would admit he made some mistakes trying to do things a little too quickly, too fast. But he had a good core concept, which was essentially to build stores within stores of JCPenney, and among other things, that would dramatically increase the sales per square foot. Didn't work out. A month or two prior to the meeting, Ron Johnson left JCPenney. They then brought back the guy they let go to bring Johnson in, Mike Ullman, who I actually like. He is a really good operator. I think, to some extent, the grass is always greener when it comes to rotating CEOs in and out. But they are now through the Johnson debacle and trying to essentially rebuild from these more or less self-inflicted wounds. The reason that revenue fell off a cliff was very much related to a lot of store overhauls and just the transition the company was making to this sort of shop within a shop or store within a store model, where you'd walk into JCPenney and you'd see a specific area designated just for Nike or eventually Disney or for Levi jeans. And it would have a cool, sort of Apple store feel to it. Everybody's walking around with iPads to check you out instead of registers. It just got a little bit more of a design in there. The problem was, those weren't really the shoppers that had long since gone to JCPenney, and those sort of bread and butter customers just kind of abandoned things when the discounts stopped and the coupons stopped, and they tried to shift gears. So, the point being, JCPenney was something I've been watching for a while. I was actually able to even, through the miracle of technology these days, able to do, or probably liberally called channel checks, just sitting from my desk in the office here in the Keys. You can these days, and this was all through a company called gigwalk.com, where you basically hire 30 different people all over the country to go out over the course of the same weekend and check in on JCPenney stores. So, one of the downsides of being in the Keys is that when it comes to retail in general, I'll be the last person to know if something falls out of favor. Right? If it's not, flip-flops and shorts, then I'm going to miss that trend. But these days, it's fairly easy to have other people go answer those questions for you. And long story short is the weekend that Joe Fresh, which was going to be a fairly significant, at least in terms of PR, new addition to that store-within-a-store concept, I figured, all right, well, let's take that weekend and have some folks look around. Had the people take all these pictures, ask them some questions, just general sort of intel and data gathering. Some of it was good, some of it was bad. Confirmed some things about what JCPenney had to still do. But in reality, either way, you get a much clearer opinion of things through really just sort of doing your homework. Just kind of a neat little tool I discovered to hopefully use again in the future. But point was there was some serious work involved in JCPenney for some time. These are some of my favorite sort of toxic headlines warning everybody away from, and these were really right out of my RSS feed for JCPenney prior to the annual meeting. Margins are horrible. The man who is Jim Cramer, calls it an unmitigated disaster. My favorite one is the one at the bottom. 2 ways that JCPenney makes even Sears look good. What kind of idiots would start considering investment in JC? Oh wait, yeah, that's us. Fast forward a little bit here. Remember this number. This was the market cap again right before the annual meeting. The whole market cap of JCPenney, is just under about $4 billion, $3.96 billion. So let's for a moment presume that none of the pundits, the Jim Cramers of the world, really, are looking at things on a fundamental kind of value investor basis. And if nothing else, let's just divorce ourselves from all the emotion and all the drama surrounding JCPenney and try to take an independent, rational look at what that business might be worth. Remember, $3.96 billion. Here is a slideshow. This is from an SEC filing that JCPenney made with the SEC with regards to some debt that they're going to sell. And this specific presentation came out a little bit later in my own analysis, which, number one, would have been good to have this earlier on, save a lot of work. But the point is, this is more demonstrative than a core part of things. But I do think it really underscores the difference between looking at something as a value investor and somebody who just sees shares of stock flying around like pieces of paper in a hurricane. Again, kind of a wordy slide, a lot to it. The point I want to highlight is essentially this. In this SEC filing that JCPenney published, and i.e. something that's going to have a serious amount of effort behind it and can be taken as reasonably objective, the company is citing a Cushman and Wakefield appraisal. Again, Cushman and Wakefield, very well respected real estate firm, got a lot of different sort of silos under what they do, but one of the services they offer is appraisals for these sorts of collateralized offerings when it comes to debt. Cushman & Wakefield is concluding that $3.3 billion is the value of JCPenney real estate in terms of owned and ground lease stores, and another $0.76 billion is what an independently derived valuation for the company's own distribution centers and sort of headquarters there in Texas. All right, you add those numbers up, you get $4.06 billion, which in and of itself is fairly anticlimactic. But to go back to that previous slide, the point is, and this is greatly simplified, but the point is, that stock market price in the previous slide, the market cap of JCPenney, I'm talking specifically, all of JCPenney could, in theory, and a little bit hypothetically, be bought for that $3.96 billion figure from the previous slide. If you just started buying every share of JCPenney and didn't stop until you'd bought, that $3.96 billion number, you would de facto be 100% owner of JCPenney. Here, though, you have an independent expert valuation that's telling you the real estate value of the company alone is worth $4.06 billion. So if you knew nothing else about the status of the Levi's store within a store rollout at JCPenney, the histrionics around the travel patterns of the former CEO between his home and Texas. If you just divorce yourself of all that and look solely at the value, you would realize that today you can buy JCPenney for less than the value of the real estate on its books. You're essentially getting everything else for free. My own investment case in JCPenney is based on the value of that real estate and the fact that all they have to do is to go back to basic retailing, and the business is, by really any demonstrable means, really significantly undervalued. We bought right around in there, as per the arrow. Again, it was just a few weeks prior to the meeting. It was about $15 a share. About a week later, it came out that hedge fund billionaire genius George Soros bought about 8-9% of the company himself. It typically doesn't happen like that, where we buy things and they go straight up. And it's since come down in the last few weeks a little bit too. But the point is that we got a little bit lucky in terms of timing there. Had been watching it really for probably a good 9 months, and was just kind of biding time, doing legwork. It's a good example of, I guess, just being patient and trying to make sure that the price is right, and it's going to work out pretty well. When you ask what's JCPenney worth, I think the short answer, it's worth at least twice what we paid for it. With a couple other levers, it could be worth significantly more than that. We will see how it goes. They've certainly got some work ahead of them. They're not out of the woods yet in terms of bringing back the customers. But just in terms of getting a lot of the drama behind them and focusing strategically on what needs to happen, that part is been largely addressed. So not going to turn on a dime. Next quarter could still be a little bit choppy, but the point is it's still cheap, and as long as we're patient, we can realize that value, all things being equal. All right, so that's JCP. I want to talk a little bit more about Velti, which has been a little bit of a problem child for us. I bring Velti up in the meeting because it's, number one, it's probably a little bit example of sticking to your circle of competence. One of the key concepts of being a value investor. To be clear, I'm not quite sure anybody has really developed a circle of competence in mobile advertising specifically, but I guess one of the ways I would distinguish myself from other value guys is that I am comfortable in certain technologies. Used to work in telecom for a few years before I got into sort of the investing game. So I feel like, a reasonably good understanding. I consider telecom and some software companies kind of in my circle, and not everybody else does, but it's probably relevant in explaining at a high level why Velti was interesting and still is. It's also probably a good example of just sort of having patience, having some conviction. Well, let's just get into it. I did like this quote very much from Larry Page, CEO of Google. I tend to agree. Again, I'm a little bit biased, I suppose, at this point, but there are a lot of amazing things about mobile specifically that are opportunities for businesses. It's easy to get carried away with the hype, and I might sort of lump Facebook and some of those more social media derived companies with big mobile efforts in that category, but we're not talking about them either. So you can find just about any sort of bar graph or chart you want, underscoring how important mobile is going to be, and it's always good to be very skeptical about a lot of very impressive sounding predictions. But the reality is there is some real truth to certain aspects of that mobile story, if you will. And specifically in 2012, people who track these sorts of things, again, it's not my data, but there are independent experts who put the amount of dollars spent on mobile marketing at just close to $7 billion. It's going to hit, by these same experts, about $20 billion in 2015. So that's some serious growth. Even if you have those estimates, it's still, the math is still fairly impressive. couple more slides in here. One of the big efforts, at least sort of on a micro scale in the industry, and one of the real values I think of mobile advertising specifically on on smartphones, iPads, and all that, is really captured in this slide. There's a cross-screen brand campaign approach to marketing that's in its infancy, but is going to be growing quite a bit based on statistics sort of like this. So again, a lot of drivers, a lot of nice sounding bar charts to explain why this is going to be a big deal. In general, it's good to sort of trust but verify, I suppose. More specifically, when it comes to Velti, to understand Velti, I feel like is to really kind of grasp the idea that business, and really small business, it's really a battle between revenue growth and cash flow. When you're talking about companies like Velti, fairly small by market cap, formerly venture capitalist-backed tech companies with huge opportunities in front of them, sometimes those companies emphasize one part of that battle. They emphasize revenue so much that they never really pump the brakes long enough to let the cash generated in their business catch up. So in a nutshell, that's kind of where I view Velti is right now. They poorly navigated the transition from the startup team to the more professional public management team. They kind of absolved themselves of those sins by just growing really fast, nonetheless, for a few years. But before too long, it became apparent that the folks in the CFO's office in particular were fairly weak and needed to be ousted. And not too long ago they were. Velti has a new CFO, a gentleman who was at Sybase for a long time, right up until acquisition. He's a very impressive person in himself. More to the point, he represents a real adult in the room when it comes to Velti, at least looking ahead, and then kind of clean up some, I don't know that I'd call them questionable, but at least poorly put together deals, acquisitions they made in the past, just have had a real time getting their cash collections under control. And when you fundamentally boil it down, this is a slide from Velti's own presentation. But if you consider where the company is now, which is right at the net working capital level, at least bouncing around there, which seems crazy to me for a company that's growing so fast in an industry that in and of itself has so much growth ahead of it. Velti's guesstimating, and this is the new CFO's guesstimates, by the way, so I think we can give them some real credibility, that they're going to have free cash flow generation of about $40 million in 2014. And that's on a $110, $120 million market cap company with revenues growing about 20% a year. That in of itself is fairly distinct. If you further presume that the new CFO knows what he's talking about, and that could be elite, but if you further presume that free cash flow growth is going to hit that 40% CAGR, 40% per year through 2016, then no matter what, and independent of all the noise, Velti represents a real opportunity to do right by owning shares. It could be a 3 or 4x scenario. I think shares right now are kind of in the toilet still because the market's waiting to see, all right, is the new CFO, going to be able to successfully navigate the business through the next quarter or so without having to issue more shares and raise money? I don't have any particular insight on that other than I feel like if you just simply do the math and make any sort of reasonable guesstimate at the worst case scenario, if they do have to issue more shares, well then maybe Velti, maybe it's no longer a 4-bagger, it doesn't go up by 4x, maybe it's just 2x, or occasionally even a 50 or 60% return in a short period of time. I think we can live with that. So Velti, again, has been a problem child for us. Started nibbling at much higher share prices, doing a little bit more buying more recently when share price is drifting lower. Unfortunately, right now in early July, the price is even lower than that. But in case you're wondering what I'm seeing in there, that's sort of a shortened version of it. I do think it's going to be worthwhile sticking around and see what happens with Velti in the not too distant future. So a lot of angst in the rearview mirror, but the next 6 to 9 months at Velti are certainly not going to be like the previous 6 to 9 months. Really, any way you can